Hello, I'm Simon Roderick, and I'm the Managing Director of Fram Search. I'm delighted to be joined today by Keith Grindlay of Macro Thoughts. If you remember, I spoke to Keith right at the beginning of the COVID-19 crisis, and it's a delight to be able to talk to him now as I hope we're exiting that very difficult period. Keith, how are you today?
I'm very well, thank you, Simon. Slightly back to normal, but still getting there.
Keith, if you wouldn't mind just reminding people again of your background and just tell them a little bit about Macro Thoughts, I think that'd be good context for the rest of our conversation.
For sure. Macro Thoughts is a independent research company. My background is trading for the sell side for large investment banks, and through the financial crisis, I was fund manager for JP Morgan Asset Management, running Global Macro. So as a research company, we don't come from a economics kind of directive. We come from, we work on the idea that we work with managers to leverage our strategies and our forecasts. So our clients tend to be either European investment banks or family offices in Europe, or large fund managers for foreign exchange. So we cover all the asset classes from commodities, foreign exchange, bonds, equities, of course. And we remain completely independent. And our ethos is that we work closely with clients to help them either hedge or improve performance.
Let's make it very clear for anyone who watches this. We're not talking today about giving investment advice or anything like that. We just want to have a general conversation about what's going on in the world. I need to flag, Keith, I'm going to say it again. I said it in our first conversation. You were the first person that told me that COVID-19 could be a real threat to to the world economy, and obviously then the UK economy. You were way ahead of anyone that I was speaking to. You're also a very well-known and well-read individual when it comes to the Chinese economy as well, which I'm sure will be very interesting for this conversation. Keith, as I say, we spoke at the beginning of the coronavirus crisis. We're now coming out of it. There's things out there that people are talking about inflation and supply chains and things like that. I guess my question is, how do you feel we've performed in the UK over the last 12 months? And what are your thoughts perhaps on inflation globally?
Okay, so we look at things, supply chains, trucking levels, warehouse costs and things like that. So we first flagged up the potential for inflation last August, higher bond yields in August, and supply chain issues in August. So we were probably one of the first to actually call for the inflation story. And we think that this inflation story is playing out on a CPI level. So this is what central banks concentrate on. But on an inflation level, there are still issues, because although CPI will have base effects dropped out, the inflation story is still there and the supply chain issues are still there. So, for example, in the US, they had probably 45 ships outside the West Coast LA ports. They've now got 65. The trucking no-shows are around 30% of the port. So even if they are unloaded, they're not necessarily collected, and warehouse costs and finding a warehouse to place or store inventories right now is an issue. And this is where we see the next problem, because the lead times now in the US, if you look at, for example, ISM data, the lead time is now around 90 days. So that if you signed a contract 90 days ago, plus the agreement on the contract, it's taking you nearly 4 months for your products to arrive. So even if you manage to get the supply into your stock rooms, then you've then got to think about the consumer. And is the consumer in a position to be spending on, let's say, non-discretionary goods when they have to be paying higher food prices, higher energy prices, and that doesn't leave a lot out of the budgets at the end of the day, especially when you're still a certain amount of uncertainty around. So our biggest fear for next year is not necessarily inflation, it's a growth story. Because we look at this, or if you think that supply dictates inflation, it's demand that dictates growth. And if we find that next year that the consumer activity is not as strong, then we might find that the consumer prices actually come off slightly, especially for discretionary goods. And then we have a problem for producers because they pay top dollar for the products, for materials. Most products now, or most production lines rely on immediate delivery immediately onto their production line and rely on no excess at all. And that's why the likes of Ford and GM are having to mothball some of their factories because they don't have the supplies that they should or would normally hold. And therefore, coming into next year, as the supply of semiconductors, etc., start coming online, I think there's the danger of overproducing and producers having to cut margins to sell their goods, and therefore we could have a growth story next year that slows growth, and we have a widening of producer and CPI for prices.
And is this, at the moment, as we've heard, there's a surge in demand as the world reopens, and then you're talking about potentially later on being maybe a surplus or whatever. This is all lockdown related by the sounds of things, is it? This is supply chains being disrupted due to global lockdowns.
Yes, I mean, we talk about the amount of demand being around, but if you look at retail sales in the US or the UK, or factory orders in Germany, industrial production right now, the demand is really at wholesale level, not necessarily at consumer level. And if we're at wholesale level and restocking, take for example cars. We talk about semiconductor problems and things like that, but a lot of the rental fleets were reduced or mothballed last year when there was obviously no rental cars being in demand. So the immediate effect earlier in the year was to replenish these fleets. Now these fleets are replenished, but there's not necessarily people coming out and renting a car on a regular basis again. So, we talk about higher energy costs now and oil prices, but, we haven't really, the demand level is slow in picking up. So there's a danger that the speculative higher prices, the same way that commodity prices did in May, for example, lumber prices hit a record in May, and they've collapsed since. And that's the story also with iron ore and the like. So with China slowing, which is a story that's not just about COVID, it's a story that's been slowing because of what's happened politically in China. There's a risk now that the consumer activity is not as strong. Fine, we can go out for meals, but if you suddenly find that going out for a meal is going to cost you, I don't know, twice what you expected, and when the bills start coming home, you think twice about buying or going out to eat rather than having deliveries, for example. So, that lockdown euphoria has not lasted, I don't think, as far or as long as many commentators really thought they were going to.
Yeah, and of course we had the national insurance change as well, which is, again, if you're talking about a demand issue, that's going to certainly stifle demand a little bit. People got less money in their pocket. Actually, Keith, that's a good way now to talk about the UK specifically. I mean, obviously, we're talking the day after the Prime Minister made his party conference speech. He's talking about a high wage economy. There wasn't much in there really about what's going on with the fuel crisis or supply chains in general. What does all this mean for the UK specifically?
Okay, so supply chain is an issue globally. So we know that Europe has a problem, and the US has. And one of the arguments is that the US should stop exporting oil and energy out now, and that would help their own supply issues. But obviously, that doesn't help global supply issues. Russia is now stepping in and saying that it would increase production as well. But again, it's about the supply side dictating inflation and costs and prices. And the market was pretty quick in picking up on the idea that that supply will be hampered. But we're talking about lorry drivers and haulage firms. Now, the issue with haulage firms and lorry drivers is an issue that the US has been trying to tackle for the last 5 or 6 years. It's a heavily regulated industry. And when an economy comes out of a recession or an economy improves, lorry drivers tend to move to other industries, less regulated and better paid. So naturally, you're going to have an issue. Clearly, there's a part issue because of Brexit, but I think that equally, we've globally had this a paradigm, if you like, or a lasting ease for corporates in that wages have been kept low because of zero-hour contracts and self-employed, which was something that grew out of the financial crisis. A lot of people in the US, and this is why the Phillips curve hasn't worked, a lot of people had to take pay cuts just to get back in the workforce. And that is not priced into central bank thinking. So that coming out of lockdowns now, and there is a labour shortage, but if you look at the unemployment rates, and not so much the UK, more in the US, there's still the unemployment rate is relatively high. The real unemployment rate is relatively high. The UK it has a different issue now, not an issue, a benefit, if you like, because equally coming out of Brexit, I think that there's a demand for moving into UK, for foreign investment to come into the UK, and that will help sterling, for example. So I think the property market's done very well, and I think you're seeing another resurgence in property demand, especially maybe in London and the southeast, and that's possibly from money coming out of the Far East, where we might see a resurgence of heavy investors, big investors coming in and buying high-end properties. Obviously, that will distort, if you like, the house price indexes, but I think that it's a positive for the UK. Construction will be a positive, infrastructure projects and things like that. But the big thing again is we got VAT increase in the new year, and we're going to start having to think about importing and trading and changing trade agreements. I think the switch and working with Australia and New Zealand and the US on trade deals is positive. But for example, our trade with India is pretty poor when you think that the trade, Belgium's trade with India is stronger than the UK trade with India. Then there's a lot of work to be done still. I think equally we're beginning to see, or I think you'll find that for example, container the shipping companies, haulages have realised the strength in the same way that OPEC realised their strength in dictating prices. And we're talking about, so for example, a container ship going from China to the US, and that's moved from about $1,500 to $15,000 a container. Now this is a massive increase, and we know that this is going to extend into 2022, 2023. So I think that we're going to start seeing that these companies or these industries have become more aggressive in their pricing, and that is something that the industry and, if you like, producers and even consumers are going to have to start to get used to. Higher prices, I think, is something that will last maybe 4 or 5 years now, and not be sort of a CPI story where base effects drop out. And because of that, I think you're going to start getting wage demands come through, which, it becomes a positive, because if you've got stronger wage and pay rises, your confidence, consumer confidence grows. And, the UK relies on property markets to really get the property market to continue its strength. You need to have differentials in wages, enough of a wage increase for you to think, I can move up into another house or into another property. So I think that there's positive in that. A lot of the property market transition has been from from cities into more urban, more rural property buying, and that's boosted regions. But I think that there's a chance now that we start to build on cities again as we start getting back to normality.
Yeah, saying I think you're right around the salary side of things and salary expectations and wage demands. I know from what I do that, talking about the city in particular, there's been very little kind of salary growth since the financial crisis. If you factor in kind of inflation, I suspect it's quite significantly down. But we're starting to see now kind of real salary growth coming in after some time. So, and perhaps as you say earlier on, firms are getting more pricing power now as well. There's been a period where there's been very little pricing power for firms in lots of different industries. So there are all these shifts taking place. And interestingly, I've been traveling backwards and forwards to Norway recently, and there are certainly some issues that Brexit's throwing at us. It's done now, but there are some issues that are being thrown at us. But when I was in Norway recently, one of the conversation points there was actually there weren't enough overseas seasonal workers that they rely on to help with the harvest or to work in hospitality. So the UK's got its own challenges, absolutely, but these are challenges I think lots of economies are seeing across the world. Again, perhaps caused by very much by lockdowns and people perhaps being in the wrong places and borders closed. And hopefully we're going to gradually work through all these problems to get a more rebalanced economy as time goes on. But it's certainly a time of change, real change.
I think that change is starting to be reacted into Europe because we've just had the German election, which it's an unsolved issue that will continue into next year. I don't think markets are necessarily pricing yet the effects or the volatility of a Europe without Merkel, without a steady German government, because factions will start to eke in. The point in 2017 was that the French election was before the German election. Now, the French election this time around is after the German election. And Macron is a long way from being expected to take the second term. Le Pen the far right will be building their usual sort of, can we do it this time? And maybe there'll be a pull from the far left. The point about Macron's election last time was he was a vote against the far right coming into France or taking some control in France. The policies that Macron was winning an election on were not popular policies. The unions, for example, would not normally have backed that sort of those policies. So that the French election could be as divisive as the German election. And then you start thinking about, okay, we've struggled to get travel into Italy, Spain, Portugal's doing better, but the tourist arrivals, the cost to tourism and things like that, the property markets in these areas of the Mediterranean countries is still an issue that's there. So I would not be too complacent that a peripheral bond market semi-crisis in Europe starts to develop in the next 12 to 18 months. Right now you can buy Greek 10-year bonds virtually at the same price as Italian 10-year bonds. And again, the ECB looks ready to, if you like, replace the emergency QE program with another program of QE wrapped up in another guide. I think that in the UK, or the Bank of England, we were never behind the idea that the Bank of England would go to negative interest rates. We were very pro fading 10-year gilt yields at around 50 basis points. We're now back up to 1%. And I think that the Bank of England would be more aggressive in rate or tightening financial conditions more than probably the Fed or the ECB. So I think that the story maybe even be for strength in the sterling going forward, and that will drag in more foreign direct investment, that sort of thing. So the development in markets of the UK or positive sides for the UK are there, And I think that if we then spin that and say, well, okay, if the UK is sucking in foreign direct investment, then the city, financial markets, wealth management, asset management, these are growth areas, potential growth areas, mergers and acquisitions. I'm very much of the view that QE is stalling the recovery. And I think that at the beginning of September, we said to expect the stock market correction, not a collapse, a correction. We forecast the March 2020, as you mentioned earlier. We forecast the March 2020 crash effect, and then the recovery. I think that we've called for an equity market correction, and I think that October's volatility hasn't gone yet. But equally, this volatility is something that we're going to have to get used to, and it has as long as it doesn't spill into the real economy, and it doesn't become too dangerous for the real economy, I think this is a positive, because corporates now need to start thinking. We've had record levels of buybacks, and we've had record levels of share issues and bond issuance, and from companies that are pretty cash rich in the first place. If corporates now have to start thinking about capex and start raising wages, developing products, and thinking about, okay, new electric cars, ESG, that kind of thing, it's a positive growth area for an economy. We start thinking about the economic growth rather than just stock markets going higher. Yeah. And if that happens, especially in the UK, I think we can develop a long-term, the shock of COVID could come out of it in the right way, if it's managed the right way, could develop into a long-term, effectively, 10 years of steady growth for the UK economy, for example, and that becomes a positive, I think.
Yeah, I mean, the city's had a very good period since all this began. And I think it's great to hear that you think there'll be more inward investment, because that'll just keep the city even busier. From what you're saying, potentially a rate rise on the horizon, or certainly an uptick in the way rates going in the UK, and then potentially some issues, perhaps hopefully not catastrophic, on the peripheral countries of the European Union, which unfortunately I think we're recovering and perhaps struggling to recover from the financial crisis, and got hit at a particularly bad time, which is desperately sad. So hopefully that they get the support they need, and they come out stronger. Talking politically, Keith, and talking about geographies, as I know you like to, we can't really ignore China. Evergrande's been in the press recently. There's lots of changes always in the Chinese economy. What are your thoughts on things like Evergrande as a risk to the global economy? Okay,
so I think that the risks in China have been largely papered over. Xi Jinping's been, since he's come into office 2012, has wanted to move away from the expansionary economy and become, if you like, more China for China than America for America, if you like. So this is an ongoing situation. 2017 was a game changer. He re-established his 4 comprehensives, and no one should underestimate how much control Xi has at the moment. But noticeably, he's not moved out of China that often in the past 18 to 24 months. So, that is a bit of a concern. Now, we've been focusing on the property market in China for about 2 years now. And at the end of last year, we highlighted 2 particular rental companies that were defaulting on bonds. And we maintained our if you like, our background risk concern that the property market in China has a serious problem. There's over 1 million properties empty. There's over leveraging, and if one property company goes under, it affects banks, it affects tenants, it affects rental companies. The whole, even just the shudder or the ripples from 2 rental companies had an impact on WeWork Bank and things like that. So when someone as big as Evergrande hits, this was a seismic hit for the Chinese economy. but it was a hit that we kind of had been expecting. Now, one of the issues is for Chinese investors is that even though you may think that you're putting money into a Chinese company, because you have 99.9% of investment into Chinese companies are through VIEs, they're vehicles for investment that allows Chinese companies to, if you like, gain access to foreign investment, but it doesn't mean that you're an owner of a Chinese company. By law, you're not allowed to. So the Chinese government under Xi has been tightening conditions. And, you know, if you notice what happened in October last year, immediately after the party conference, and Ma and the rest became a bit of a shock to the rest of the world, because suddenly you were taking an IPO which everybody had been expecting and saying you're not going to do this. Now, that Evergrande is a big issue. Foreign bondholders have not been paid so far, but the system has been maintained. There's not been a collapse of confidence in the Chinese economy or anything like that. But you still have to, you know, we're going through a phase now of volatility in equity markets globally. Chinese equity markets have been suffering for a while now, and you cannot imagine an economy with the size of China with an equity. You know, if you start to get the Shanghai Composite drop 25%, for example, the rest of the world can be affected by that. So these are issues. Now, again, we talked about inflation before. We've had a number of the largest ports in China closed or partially closed because of COVID. Some of those ports are going to open up soon, and the supply chains will start to continue. But nevertheless, we had a lot of speculation in iron ore, lumber, in a lot of the products, a lot of commodities that, you know, from May, I know we talk about the Bloomberg commodity index hitting record highs, but commodities like iron ore, lumber, corn, soybean have all been coming down. And, you know, for the Chinese economy, that again is a concern, that there is an issue there, that the Chinese economy is slowing. And if we start talking about higher energy prices, the chance of a recession starting from China next year could, I mean, you know, everyone was talking about 8-9% GDP for China at the beginning of the year. We argued, no, it's going to be more like 6 to 7%, which it's probably going to be. World growth is not going to be 8-9%, it's going to be 5 to 6%. So those growth expectations are coming down. The inflation expectations have been far too low. And so that, you know, if you look at China and keep, you know, even if you're not an investor into China, be aware that what's happening in China is a structural change that's being led by the government that started for some time ago, and they will support their economy, but at the same time, the Chinese party comes first.
So that's interesting. So, you know, we can't ignore, you know, what's happening in China here in the UK, although you've actually made me feel a lot better about the prospects of the UK, some of the things that you were talking about earlier on. But I know that obviously a lot of your job is to think about various different risks. Now, I don't know if you know, there's perhaps 2 or 3 things, Keith, that you do think are global risks at the moment that we haven't covered.
Well, I mean, we've said all along that inflation expectations have been too low throughout for the last 12 months. And we've always said that growth expectations have been too high. Though the IMF is still too high with its forecast. Maybe we've got to consider a world where QE is reduced. There's a direct correlation, if you like, with QE and equity prices, and that's been cut. I think what's not been taken necessarily on board is what's happened with the Fed and 3 members of the Fed that have been trading stocks ahead of policy decisions or policy meetings. the Fed cannot no longer be seen to be supporting equities instead of the economy. And if I use the example, in 2018, the global economy was slowing, but the Fed was still tightening rates, and immediately had to do a reversal, which we forecast they would have to. Now, if that's the case, and Powell can't, if we get a correction in equities, say in October, Powell, unless it's, if it's just a steady decline, Powell can't move away from the idea of some kind of tapering now, because inflation is now at 5.3%. Consumer expectations for inflation is at 5.3%, and the Michigan sentiment index collapsed to a record low. That tells you that higher inflation is a consumer concern right now. And the problem is, if we start thinking, or if inflation concerns slow consumer activity, then we're going to have a bit of a shock next year, because, as I said before, the producers have bought in, they've paid signed their invoices, they now have a 90-day lead time to think about. So if they bought in today, it's going to be 3 or 4 months' time before they get those onto the consumer shelves. Those people that thought that they could, or those producers thought that they could order in August or July, are not going to have their produce on the shelves for Thanksgiving this year. So we could have an inflation or disinflation shock where producers...
It's a margin squeeze, Keith. It's obviously cutting in, isn't it? It's a margin squeeze for the corporates, massively.
Absolutely.
Yeah.
That is what we're worried about, is we start seeing the difference between CPI coming off and producer prices. If you look at inward producer prices and outward producer prices, they're double. The inward producer prices are double. They're not passing on these costs now, and it could be worse next year. So that's one of our risks. I think that we could have much more volatile markets. I think the macro risk management of macro, the idea that you've got to, I'm an equity trader, or I'm an equity fund, and I'm a Forex fund, and having them completely separate is no longer a concept. You, as an equity trader, you have to be aware of foreign exchange, commodities, bond rates, macro overlays are becoming more and more important. And that's hopefully where macro thoughts can provide that service. But we speak to equity funds now who are asking about, if I'm going to invest in what's my currency risk, what is the central bank's going to do? And the piece that we've recently done is a comparison between Indian economy and Chinese economy. Do I rely or start becoming more, instead of just focusing on China, do I now start looking at other Asian economies and the importance of other Asian economies as they grow and as they become more important? Because likelihood is that the Chinese economy is going to slow or become a structurally slower, and likes of India and the rest, Vietnam, become more important. So I think there's going to be a lot of volatility, a lot of changes, and a lot of reason to be more clued up than purely being a stock picker or purely being a peripheral bond yield trader.
It's interesting, isn't it? Because when you look back at history, there's always periods, I think. Well, we very rarely have stability or peace or abundance or all these other things. But it is particularly intense at the moment, I think. The pace of change, the plates are shifting very fast in different parts of the country, both economically and politically. It is a particularly intense period, I think. Actually, we're seeing it in the work that we do, that just at a small level, people are working incredibly hard to kind of mitigate all these changes or to try and get ahead of the curve. But it seems that when you kind of plug one hole, something else pops up, and some of it's very good stuff. Some of it is very good. Some of it's cyclical. That's
why when we do our research, we don't rely purely on economic data. We look at the points that build into economic data. So if we look at inflation, what are the points about inflation? Trucking, supply chain, shipping, wage growth. These are things that we look at that affect data that's going to be produced in the next months or so. So we, instead of looking or forecasting for an absolute number for next week or next month. We look at trends within numbers. What's going to build into this trend that's going to continue, and how does that affect the consumer? How does that affect households? There has to be, in my mind, there has to be a change of mindset. This in at central bank level and at markets level and at corporate level. There has to be a change of concept in thinking a little bit more about what affects what. If that happens, how does that fit within the spheres of what's going forward? It affects, how does that affect my business? How does that affect investors or investments? And so that it's a change in mindset that's going to be slow, because central banks are very keen to stick to their old ways of thinking. But as I said earlier, there's a difference between CPI and inflation, and seeing, and when producer inflation is more of a risk to the economy than consumer inflation, if you like. If for example we talk about S&P and hitting new records, if you look at an equity such as Caterpillar, for example, Caterpillar was one. It was a sign that there's a resurgent, a recovery, an optimism coming through as its stock moves forward. But Caterpillar shares have been coming down since June. So, that's a warning sign. If you have, we predicted in May a commodity market correction. And then we said in July that the oil prices wouldn't be hitting $100, after the OPEC meeting. These are all sort of signs and signals to us that, things are not as optimistic on a global basis as commentators would have wanted to have liked then. Now we're seeing a catch up. Transient. We said back in February that transient inflation was not transient. That Powell was dragging his feet, and now we're seeing a catch up from the central banks. And we've got to remember that we're not tightening financial conditions yet. All we're doing is reducing the amount of emergency funding that went into economies. And if we start talking about $28.5 trillion worth of debt in the US, that's a massive debt burden to start passing on. What happens when the next shock happens? There's a point that says, we kind of started discussing the idea that better for the economy is to have a $1.5 trillion deal than a $3.5 trillion infrastructure and social bill. If the cost of debt, and it's seen at consumer level, the amount of credit card debt that's built up over the last few months or last sort of year. All of these things, the idea at the beginning of the year that there was consumers have saved a lot of money and then we're going to come out and start spending, has not happened. Retail sales have not boomed the way people had expected. And we've got to expect not necessarily a rush and a full-on 100 mile an hour economy. We've got to start thinking about a steady growth economy with higher wages and more of getting back to normal rather than expecting something, much more blown out, if you like.
Yeah, and I think companies are changing their mindset as well. They're thinking about other metrics. It used to be that the shareholder came first. Of course, the shareholder is incredibly important, but now they're thinking about wider societal impacts as well. I think that it's very hard, for governments to sometimes track these things and measure them. But there's absolutely no point in GDP racing ahead if you've got people that are less happy and less healthy. So maybe some of these old metrics need to be redefined and looked at in conjunction with other things as well. And therefore, governments, I think, have to get better at communicating their strategy, particularly in the UK. I think we've probably had a pretty poor period of communicating what the strategy is. So
I think that's true. We're going to start talking about the UK elections before, not too far away.
Yeah.
And, I think there's changes that are going to be forced. We've got to start making sure that we've got the carbon count down. We've got to start moving to more sustainable levels of energy supply, building wind farms in the North Sea, for example, and things like that. These are all really important things. At one point, we'd cut our coal use of coal in the UK completely, and Japan and Germany are going back to nuclear power and things like that. The ESG investing, I think, is costly and needs the homework done. But I think that we have to expect, not necessarily led by hedge funds or investors themselves, but there's going to be a demand from ultimately the people that pass the money. If we're going to start thinking about investing my money, what are my issues? Not just about making money, but what are you investing in? How are you investing my money when I do? It becomes a bigger story now than just purely saying, well, I'm going to invest in this, invest in that. So I think there has to be a change in mindset and stuff. ESG is a growth area for the UK financial area.
Yeah, absolutely. And we're very much seeing that as well. Seeing huge demand, people building out their ESG teams, as you rightly say, driven by their customers, but also a little bit of hand-holding as well from the industry, saying, well, actually, there's different ways that you can approach this. It's a hugely complex area, as you well know. So it's all good. Keith, thank you for your time. As I said to you during the interview, you've actually made me feel positive about some of the things that were perhaps concerning me. And I think it's very good to get your kind of, as your company name suggests, that macro view of things. So thank you for talking to me, and I hope you have a good day.
Lovely. Thank you, Simon.
Thank you.